Joining me in the studio today is Carlos Castellon, founder of Castellon and Halloun CPA. Carlos, thank you for being here.
Thank you, Omar, for having me here, and Severa Realty for inviting us.
Very happy to have you here, Carlos. And today we are talking about the most frequently asked questions that those who are investing in real estate that are non-residents in the U.S. have. You hear these all the time, and we're going to break them down for our listeners, what they need to know, right?
Sounds good.
So let's get right into it, Carlos. So number one at the top of your list is, do I need a visa to buy real estate in Florida?
A lot of people worry about that. No, you do not. You do not need a visa to buy real estate in the United States. You may need a visa, depending on which country you come from, to come fly to the United States, but definitely not a visa to buy real estate here.
Okay, excellent. And then I think number two on our list, which I've heard this a lot and have heard associates ask about this, and that is their buyers want to know, should they buy under their name or under an entity?
Yeah, they definitely can buy under their name, but we don't recommend it. Why? Because of asset protection. If there's a lawsuit, they can go after all your assets. They could sue you individually if you own the real estate under your name. But if you own an entity, they can only sue what the entity has, and that's why we always recommend to have one entity per real estate investments.
So, Carlos, then the entity is preferred in the sense of protecting yourself, correct?
Yes, protecting against a lawsuit against yourself if you buy it personally. So the entity, if you have an entity and there's a lawsuit, they can only go after that entity's assets, not your personal assets.
Okay.
That's the story. That's the reason behind it.
Very important. And then number three on your list, Florida is one of the most popular states for cash buyers, right? But then the other option, of course, is financing. So the question that you get a lot is, should I finance my purchase? What do you say to that?
Yeah, a lot of Latin Americans are used to buying it in cash. I would say do the numbers. I mean, in the U.S., it's relatively easy to find out comparable rentals. Okay. So you have your idea of how much rental income you're going to get, and you have a pretty good idea of the expenses. So if you throw in a mortgage, sometimes remember, you're putting less money down. So your return on your investment as a percentage may be higher. You can also diversify, and instead of putting 100% cash down, buy two properties, finance 50%. If you're renting it, if you're renting that property, the tenant will pay for that mortgage basically, and you can deduct the interest expense on it. So it's something to consider. Recently, though, I've always liked the 15, 20, or 30-year fixed rate mortgages.
Sure.
But I just bought a property this year, and I went with a 5/1 ARM. A 5/1 ARM, what they do is gives you a lower interest rate right now for the first 5 years. And I'm very certain that within the next 3 to 4 years, maybe less, the interest rates should go down.
Sure.
So that might be a way to buy it right now with the lower interest rates, and then you can always refinance later.
Right. Okay, so that's a good tip for the listeners out there. Question number 4, what's the best structure to reduce income taxes when investing in real estate?
Definitely a limited liability company with a foreigner as the owner is definitely the cheapest way as far as income taxes. For example, if you keep the property for at least 1 year, you get a benefit called the long-term capital gains rate, which is the first $45,000 of appreciation is tax-free, zero tax, which is great.
Sure.
Then from $45,000 to $500,000, it's only 15% tax. And then beyond $500,000, it's only a 20% tax. So that's something definitely you can't beat that. It's an incentive that they give to not only non-residents, U.S. people as well, to buy real estate. So long-term capital gains rate is definitely the way to go. And I would not buy a property for a year and then sell it. Definitely, you should look at a 3 to 5 year horizon.
Sure, more of a long-term,
Yes.
a long-term play.
For sure.
What about estate tax at the state or the federal level for holding real estate? How does that play into it, and does that impact in any way how the LLC is structured?
You have to look at the income tax, but you also have to look at estate tax. There is an estate tax at the federal level, and there's also one at the state level, but it depends on the state. Florida is exempt. Florida has no income tax at the personal level nor estate tax. So that's one of the benefits besides the beautiful weather that we have here,
Right.
to invest in Florida, But the estate tax is something that could be pretty hefty. It's an 18 to 40% tax on the value of the property at time of death. So you definitely have to consider that when you're buying real estate, which is the best structure for you. An LLC is the best for reducing income taxes, but not to eliminate the estate tax. So that's something to consider.
Interesting. So that dovetails nicely into your next question, which is how does one mitigate this exposure?
In an LLC, for example, if a client wants the LLC structure, which is the best for reducing income taxes, but you're exposed to potentially, if you pass while holding the property, you have an estate tax problem. So what we have done is instead of buying the property yourself, you buy it with your spouse, or if you have family members that are over 18 years old, you add them in there. Because if someone passes, it's only one of them. So you divide the property or the estate taxes into let's say a fraction. For example, you have $1 million property, you were to pass, you could be paying $400,000 of estate tax. But if you divide it into 4 family members, one passes, the value is only $250, the estate tax is cutting 1/4.
Interesting.
So you definitely should consider adding family members. Another thing that we have done is take an estimate of the possible estate tax. Let's say it's $100,000. So you get a what they call a term life insurance for $100,000 on your life. If you pass, you get the $100,000 and you use it to pay the estate tax. You don't have to liquidate the real estate.
This brings me to our next question. So what is the ideal structure to eliminate the possible estate tax then?
Yes, when I've traveled to Latin America, a lot of people think the LLC is the go-to because it is for income tax purposes. But if you definitely want to get rid of the estate tax, you buy your property under a corporation instead.
Okay.
And that U.S. corporation is owned by a foreign entity.
Interesting.
That structure has already gone to tax court, and it's bulletproof. It's definitely 100% proof that you do not have an estate tax, because if the foreigner were to die with that real estate holdings, your interest is considered offshore, not subject to U.S. taxation whatsoever.
So this is what commonly referred to as what? Is that an S corp?
No, S corps are for U.S. individuals only. It's a C corp, a regular corporation.
C corp, okay.
In Latin America, it's called a Sociedad Anónima.
Okay.
It's a corporation, a U.S. corporation that's owned by a foreign entity. For example, we just came back from Pereira, Medellin.
Yeah.
And what we did for the foreign entity, so people could save some money and don't have to buy a new foreign entity, is use their SAS. They have corporations in Colombia or in whatever country you're at. You use that corporation, which is a foreign corporation, to own the U.S. corporation, which owns the property. That gets rid of 100% of the possible estate tax.
Okay. So then, just to recap with my listeners, because we're flying through this, and I think you're doing great, but I just want to make sure we're up to speed here. So if you're buying individually as a non-U.S. resident under your name, you're exposing yourself to legal issues in the event of a lawsuit, right?
Correct.
If you buy with an LLC, you are then reducing the amount of income tax, right? That's the big pro there.
Correct.
But then you leave yourself open to, should you pass away, big estate tax for the recipient, the inheritor, right?
That's exactly
so
the
I get
dilemma.
an A+ on.
That's exactly the dilemma. You either reduce your taxes or you're exposed. Like, for example, I had an Italian client that came and wanted to buy a South Beach property, multi-million-dollar. He was in his 70s. It was for his grandchildren. Speak no more. C corporation with an offshore,
C corp,
and that gets rid of the estate tax.
So then with C corp, which gets rid of your estate tax, we gotta have like some acronyms or something, or mnemonic device. C corp gets rid of estate tax. What's the downside there? Is there a downside?
You pay a little bit more income taxes.
A little bit more in income tax.
Yes.
Okay.
But it's almost like an insurance policy.
Insurance. Okay, I like it. So there's 3 options right there. The next most frequently asked question, Carlos, is people hear that in the U.S. you pay a lot in income taxes. Is that correct?
That's a myth that's totally incorrect.
Okay.
For example, on ordinary income of $100,000, you pay less than 18%. That's less than most Latin American countries. Definitely less than Europe. So it's definitely, but you definitely can evade income taxes. In some countries, I know people fool around with the taxes, but you can't do that here. You've all heard of the story of Al Capone. Right. He wasn't put away for his criminal activities, but for tax evasion. So you definitely have to file. And believe me, we have quite a few amount of rental real estate owned by foreigners.
Yeah.
And they pay no taxes on a yearly basis because we have so many deductions that we can take.
So if I'm following this correctly, though, let's say if I'm a non-U.S. resident, I own a property in the U.S. and I'm when it comes to filing income taxes, are you disclosing just the income on your rental properties or also your income from your home country?
Excellent question. If you're a non-resident, you only file in the U.S. what you make in the U.S. So if it's a rental property, that's the only thing you have in the U.S., that's what you're reporting.
Interesting. So I guess the common, concern might be as a foreign national, let's say you're diversifying and you're saying, whoa, I'm paying on a lot of my home, my native assets. Next question, Carlos. Do I need to travel to the U.S., let's say, to establish the LLC or a corporation?
Not at all. We could do it all online. We do most of our incorporations online, so they don't have to travel here. Now, you may need to travel to open up a bank account, because that's the next step. First, we incorporate, then we get a federal ID number, then you open up a bank account. And if it's an LLC, I love to have them open up an LLC bank account along with a personal bank account, so the profits
go into the LLC.
Into the.
So you don't have to travel, but you may need to be in person to open up that bank account.
Right.
And then you're going to want to have a business account, a personal account.
Right.
In Miami, new construction, right, is super popular. Especially our South Americans and really all over the world now. Miami's such a global community. Love new construction. Miami offers some of the best of it. If you're putting down a down payment on a new construction or otherwise called pre-construction project signed under the individual's name, how does one change that to have a structure that is more appropriate, let's say like at closing?
Correct. Yeah, that's very common. You usually look at a property, fall in love with it, with that project, and then you sign under your name. You just got to make sure that you add and or assigns after your name. That means that you could change it and put it or close under a corporation or an LLC. What's best suited for you, though?
Sure.
You have an option. You don't want to buy it under your name, so you sign under your name and or assigns, and before the closing, actually I would suggest a couple of months before the closing, you look at which is your best structure. Is it an LLC with you as the owners, with multiple owners, or as a C corporation with the foreign entity on top?
Sure.
So you have, when you add and or assigns, it lets you do that change.
Excellent. So that's essentially assigning the ownership.
Exactly,
right?
exactly.
So let's talk about another common topic, common theme, and that is FIRPTA. I guess non-U.S. residents may have heard of this. Our realtors have heard this. What does that mean? What is that, FIRPTA?
Everybody gets confused with FIRPTA. It's incredible. The main thing I want to point out that it's not the actual tax. That's the main thing. Everybody thinks it's a tax. It's a tax that the IRS wants to collect up front, just in case a non-resident sells the property and gets lost, basically. They can't collect the taxes. So it's a very high tax because it's 15% of the selling price. But that's not the actual tax. The actual tax is based on the appreciation of the property, and that's the actual tax. For example, you bought a property for $900,000. You sold it for $1 million. You made $100,000.
Okay.
FIRPTA says if you have it, and FIRPTA only applies, by the way, to non-residents, foreign entities, or an LLC owned 100% by a non-resident.
Okay.
It's only foreign-owned type properties, okay?
So the IRS, sorry to interrupt you. So FIRPTA applies to all of the options that we've talked about thus far, right? Corporation, LLC?
No, not corporation.
Corporation.
Only LLCs owned 100% by a non-resident. A non-resident owning the property himself, which is not what we suggest. Or a foreign company owning the property, which is sometimes the case as well. A foreign company owning the real estate here.
Okay.
That's when FIRPTA applies. So let's say, again, you buy it for $900,000 and you sell it for $1 million.
Right. Made $100,000.
You made $100,000. FIRPTA, the IRS wants you to collect 15% of the selling price, which is ridiculous. It's very high. 15% of $1 million is $150,000. Now, if you bought that property under an LLC under your name, with an LLC, the tax on the first $45,000 is long-term capital gains rate, preferred rate. It's zero tax.
Okay.
And then from $45,000 to $500,000, in this case up to $100,000, which is your profit, is only 15%.
Okay.
So in reality, a tax is close to $10,000 on that $100,000 profit. They withheld from you $150,000. It's really a timing issue.
Right.
What we do is at the end of the year, we file your tax return and tell the IRS, hey, the profit is $100,000, my actual tax is $10,000. You withheld $150,000, I want $140,000 back. Now, a lot of clients ask me, my country, they never refund those taxes. Oh, they credit it forever. Not in the U.S. They definitely will pay you if they make a mistake. If the IRS makes a mistake, they'll even pay you interest on it. So you will get your $140,000 back once we file the correct tax returns. Now, there is something called a withholding certificate, which is like a preliminary tax return that we do at time of closing.
Yeah.
But it's taking so long for the IRS to process that I might as well wait for the end of the year and do the tax return.
Okay.
It's usually quicker like that.
Excellent, Carlos. So FIRPTA essentially comes in when you're selling, but there's some good news there in terms of getting the refund back right in the U.S. That's good news.
That's correct.
Now let's talk about another popular question, which is whether or not there is a way to defer income taxes when you have appreciation and sell the property.
It's called IRS Section 1031, which is a code section within the IRS code. And it's also called like-kind exchange, which means you have an investment property, you sell it, let's say you have a lot of appreciation, you're going to pay a lot of tax depending on your structure or not. But if you pay enough taxes that you feel like you don't want to pay it at this point because you want to buy more properties, you have to buy the new property at the same price that you sold the previous property.
Okay.
You could buy one or more properties. Let's say you sell a property for $1 million and you owe $100,000 in income tax and you don't want to pay that right now. Well, you buy one or two properties or more that total $1 million or more. You cannot touch those funds. Those funds have to be in an escrow account and those funds have to be 100% used to buy the new properties. If you do that, you have to be able to do two things. You have to identify a new property within 45 days, and you have to close on that new property within 180 days. If you do all that and you qualify, then you defer that $100,000 of income taxes until you sell those second properties. For example, I had a client 10 years ago that owed $100,000 in income taxes. They had a great appreciation. They had a building that they wanted to use. They were expanding. They wanted to buy a bigger building. So they sold it. They had to pay $100,000. We did a like-kind exchange and bought a more expensive building, and they still haven't sold that second building. So you're deferring all those taxes. Think about $100,000 today versus $100,000 10 years ago. Inflation alone, a big difference. So it's definitely worth to defer if you have a substantial amount of income taxes and if you want to reinvest back in the United States.
Right. Okay, so that's a great option there. Some good news. And last but not least, are there any recommendations that you feel are necessary to purchase real estate and that can help our listeners?
Yeah, from a tax and non-tax point of view, from my point of view is I want to know an area. You want to know the area really well, so you know the prices and you could tell when you have a good deal or not, when you're buying. Also, you have to have a realtor, a real estate broker that you have confidence in, that gives you good advice. So once you know those two things, the next step would be the right structure for a non-resident alien. If you have the wrong structure from the beginning, it could cost you taxes, it could cost you estate tax, it could cost you income tax, or you would have to redo the structure and basically sell that property to yourself under the new structure. So it's definitely very important to have the correct structure from the beginning as a foundation.
So it's critical then for listeners, whether you're a realtor or you're a non-U.S. resident, to consult a CPA like yourself to really get informed and see what the best options are before making that purchase.
Correct. Every situation is different, and definitely what's the best structure. Do you want to minimize the income taxes? Well, use an LLC with you or multiple family members. If you're worried about the possible estate tax, use a C corporation with an offshore. So it all depends on your situation, your holding period too. You want to hold it forever, obviously you got to be more careful about the estate tax, or if you want to hold it short term. We have done it sometimes for clients that have some properties that they want to flip in a couple of years.
Right.
We'll do an LLC, which is the cheapest way, the least amount of income taxes you will pay. You want to hold it for a longer period, maybe use a C Corp with an offshore. So it all depends on your particular situation.
The situations and the needs. I think that's a great way to look at it. LLC for short term, the C Corp for the longer term.
Correct.
And then there's obviously many nuances in there, that would be specific to each person. So Carlos, final thoughts for our listeners. This has been a great sort of crash course. I know you can go deeper into the topic, but tell me. I know you host a regular session, right, where you sort of dish out some of this knowledge for listeners. Tell us about that.
It's in Spanish, asesoría total, which means we have an immigration, we have a real estate broker for financing the properties. We have me for taxation and real estate professionals that would come in. So it's the first Wednesday of every month at 5 p.m. You can see it through our YouTube channel or through our Instagram. And you have live questions to any of us. Mm-hmm. So we'll have 4 or 5 professionals that would answer your questions live. So it would help you with your decisions.
That's excellent. And the YouTube channel is what?
Is the YouTube channel, and on Instagram it's Castellon CPA.
Castellon CPA, okay. Yes. And the YouTube channel by the same name?
I'm not sure. I think it's a longer.
Well, we'll put it in the show notes regardless. Okay. So, Carlos, give us a final thoughts for listeners out there that are considering investing in the U.S. as a non-resident.
Yes.
What do you say to them?
Yes, from my heart. I mean, being Cuban American, seeing what's happening in a lot of different countries, Venezuela, Nicaragua, Peru, now Colombia, they're worried about the political instability. I would definitely diversify out of your country. We just went to Colombia, and we had a lot of successful businessmen there that have never diversified. 101 of basic diversification, you got to diversify, not put all your eggs in one basket. So diversify, buy real estate here. Normally, real estate keeps up with inflation. It's one of the best investments you could ever make.
I like that. We're going to leave it there for our listeners. I think to recap, diversify, right? Diversify. Mm-hmm. As a non-U.S. resident in the U.S., you have options, many options, right, that can work for you. And the key is to be informed. Find an agent that you trust. Find professionals like Carlos and his team that you trust, and really just take advantage of all the beautiful things that we have to offer here in the U.S., like a government that pays you back, right?
And Florida, no state income tax, no state income tax.
No state income tax. I mean, listen, there's no better time to be in Miami right now. Messi just came. The world continues to come here, and it only gets better and better.
It's incredible. I was in Paris a couple of years ago, and I told them I'm from Miami, and they wanted to come home with me.
Their eyes light up, right?
It's like incredible. Miami's like blowing up worldwide.
Nice.
It's impressive.
Ladies and gentlemen, this was Carlos Castellon from Castellon and Halloun CPA. Give him a call. I'm Omar DeWint here with Cervera Real Estate. You were listening to the Miami Real Estate Podcast. Thanks for listening. We'll see you next week. And until then, remember that here in Miami, the future is always bright. Take care, folks. Until next time.